everybody, and in this video we're going to look at our homework problem 3.1. So to begin, I took a snip of the kind of a screenshot here of the specifics that we're going to look at for each of the transactions, just so we have it available here. I won't have this necessarily on the template that you'll fill in, but you will have the packet and can do the problems directly. You'll have this information in your packet that you can refer to. So okay, so with that said, let's get started. So we've got our general journal here, excuse me, and I'm going to go in and just put 2000, or what do I want to do, 2021 for example. Whenever you see this X1, it's just kind of leaving off the number before the 1, but I'm just going to figure that is basically saying May 1st, 2021. So we'll put 2021 up here and just go with that. Okay, so in the instructions, we're going to record the journal entries for all these transactions, and we're going to make adjusting entries as of 6/30/2001, assuming no adjustments were made in May and $200 of supplies remain on 6/30/2001. And so you will need to make adjustments for each of these transactions. Okay, so different things are happening throughout May and June essentially. And again, it's important that the notation here that says no adjustments have been made yet in May. So if there's 2 months of activity we need to record, because we're at the end of June now and it happened at the beginning of May, we would need to record 2 months worth, for example. So all right, with that said, let's get started. So the first one, I'm just going to go ahead and put our date in here. So again, just a little bit of the format here. I'm going to just put 2021 at the top, and then we don't need to put the year every time we put below. And the first transaction tells us that $2,100 of supplies were purchased on account. Remember that we have our supplies asset, and it looks like we got a little bit of a indentation. That's a correct from a previous problem. So then we've got supplies, and remember it says we are purchasing this on account. You know what I'm going to do? I think the formatting is actually set up for this to be best put in the cells above, so bear with me there. Okay, so we've got supplies. And we are buying these supplies on account. And so remember that indicates that we haven't yet paid the cash for these supplies, and instead are going to pay it later. So we need to use our accounts payable account to record the liability to indicate that we'll pay this that amount in the future. And it was $2,100 of supplies. So assets up with a debit, liabilities up with a credit. And then we'll put our explanation in and just say purchased supplies, invoice number 553. Okie doke. And then on 5/8/2021, I'm just going to paste this in so we kind of have a running template to work off of. So this is going to be May 8th. We received $3,000 from customer company for 4 months service paid in advance. Okay, so they're paying us in advance. They're essentially making a deposit to us, right? So we received the cash, so our cash account goes up. But remember, it's not really, we haven't earned that cash yet. It's not our cash. We're just holding it for the customer as a deposit from them. And it's 4 months of worth of service. So, if you did a real quick calculation just to get this in our mind, if we take 3,000 divided by 4, it's $750. So they're paying us for 4 months worth of service at $750 a month. And that totals up to $3,000. And it's not accounts receivable, but it is a liability account, and that is unearned revenue. I thought I fixed that. Unearned revenue liability. And here in our explanation, we'll say customer co-deposit $750 per month, May to August. You all probably kind of caught on by this by now, but one little thing for Excel, remember we can put our cursor up to the columns and the side of the columns and make those larger or smaller. So sometimes if you have a longer explanation, you might need to get a little more space. Okay, so we are going to earn some of this money in May, so we'll need to kind of analyze that as we go forward. And remember, these are all the initial transactions essentially, and then we are going to make the adjusting entries as of June 30th, assuming that we have not made any adjustments, in May or June up to that point. So this is just kind of the initial transactions being recorded, not the adjusting entries yet. Those will come later, and they'll all be made on June 30th. So that's how we'll kind of know and what it's telling us to do in the problem. Okay, on the 15th, so May 15th, we paid magazine company $6,000 for 5 months advertisement to run from June 1st to October 31st. Okay, so cash, sometimes I like to just start with cash because it's kind of easier to identify. We know that cash was paid. It tells us it was paid. It was a check, right? Check's same as cash. So we reduced our cash account by $6,000, and we increased our prepaid advertising expense. Same by $6,000, right? And so we are, if we want to see, so that was $6,000, and we can divide that by 5, so it's $1,200 per month because we're paying for 5 months. And so we can say 5 months advert expense, $1,200 per month, and we'll say June 1 to October 31st for our explanation here. So that'll be helpful when we come back to have to do our adjusting entries later. Okie doke. So I think we got that one good there. Then we're going to come through and say May 20th, paid AIG $1,200 for 3 months insurance from June 1st to August 31st. So again, cash is being paid. This time it's $1,200. And it's not prepaid advertising expense, but now we've got prepaid insurance expense being recorded in this instance here. And let's see, cash being paid there. And this was 3 months insurance expense. And if we take $1,200 divided by 3, that would give us $400 per month. So our insurance expense each month is $400. And that is from June 1 to August 31st. Okay. Then on May 31st, we borrowed $50,000 from the bank. So we have cash incoming for $50,000. And then we have notes payable being recorded. And let's put our 50,000 in here. We can just make that cell. So May 31st, and we'll say it's a 4-month 8% interest due at maturity. So we've got 4-month term, we'll just say. It's 8% interest annually, and let's say interest due at maturity. Okay. So assets up, liabilities up here. And our last entry is going to be on June 1st. And we purchased a new computer. So we'll put in computer to our computer asset account, $3,900. And we bought it on account. So we'll do accounts payable there. And Oh, look, we already linked above because we copied that down, so that's nice. And let's see, what do we need to know? Office Depot invoice number 2352. And let's say, actually, just, yeah, let's go ahead and put 3-year life, salvage value of $300. So just some little helpful notes there for calculating depreciation. And okay, that's all the normal kind of day-to-day transactions that we've recorded in our general journal. And then step B, if you will, then the next part of the problem will be to record our the adjusting entries as we go forward from there. So, and we're going to do all those adjusting entries that it tells us in the problem on at the end of June. And again, I'm going to say this again. I've said it a few times, but it's telling us, assume we have not done any adjusting entries yet, right? So we have not recorded any depreciation in May. We didn't record any, I mean, I guess there wasn't depreciation until June. We didn't buy this thing till June, but we didn't record any interest. We didn't record any earned revenue for May. And we could have, because it tells us here that our service was for May to August. So we could have recorded some of this that's not the same. Sorry. I think that we could have recorded a portion of the revenue. We probably should have in May, actually. But anyway, despite what we should have done or whatever, we did not. And so we're going to need to record 2 months of revenue earned by the end of June, right? Because May and June was both months in which we earned portions of that. Okay, so anyway, let's jump in here and look at our first adjusting entry. So the first adjusting entry then that we are going to want to make is based on our office supplies. And it says in our problem that at June 30th, $200 of office supplies remain. And we originally bought $2,100 on May 1st. So we only have, like we said, $200 left. So we need to adjust down the supplies asset account. So we originally debited it to increase, but now we're going to credit it to decrease it. And we'll take the 2,100 minus the 200 left over. So now we've got 1,900 that we're going to reduce the supplies asset account by. So just to kind of show, right, this was purchased, or I'll put supplies purchased on May 1. And now just to kind of like prove to ourselves here, let me link that, that the math works. So that was our original purchase. And then here's what we know is there's 200. And so if we 200 minus 1,900 supplies, we'll say supplies used, that leaves us with $200 of supplies. And you can't see that ending balance. You'd have to look in the general ledger to see the $200 ending balance. But that 1,900 is where we get the total amount used. So we're reducing supplies with a credit by $1,900 to end at a totals of ending supplies balance at 630. And how do we know the 200? We'd have to go and do like a count, and it just tells us in the problem that $200 of supplies remain. But in real life, we'd have to do some sort of inventory count or something to determine what was left over. Okay, so that's our first adjusting entry to adjust the supplies down and record the usage, the supplies expense. Okay, and then the second entry we want to record here gets up to our unearned revenue, like we talked about. And so I'm just going to link this up. So we originally, received the cash and recorded an increase in our liability. But at the end of June, this was 4 months of service paid in advance. So at the end of June, we've now earned 1/2 of that amount, essentially. So we could just divide that by 2 because it's 4 months and are at the end of June, so May and June have been earned now. And so, like, so record supplies used during May to June, like that. And then record revenue earned during May and June. I'm just going to put an and in here. Okay, let's see. And then we're going to say, let's just use service revenue. Okay, so again, in this one, I'll just do a little calculation to kind of prove to us here. So we received $3,000 in cash originally as a deposit, an upfront payment by the customer, and then deposit, and that represented 4 months of service from May to August, and then this is May and August earned. So it's half of the 4 months basically. So then we're gonna say minus 1,500, which is 1/2, and that's what we're recording here, is that it's now earned. It's no longer unearned, it is now earned. And again, if we could see the general ledger, we would see that there's a $1,500 balance left in unearned revenue liability that we will earn over the next 2 months as we continue to provide those services. Okay, now what's our next one? Prepaid advertising. We had prepayments here for June to October. So in this instance, we had unearned revenue that was 2 months because it included May. And I'll do it. I like this little calculation style here. So we prepaid $6,000. You can do this if you want off the side. It's not totally necessary. Really, what the main thing is the journal entries, but I just want to show you all how I'm arriving at some of these figures, making sure to do that. So 6,000 was prepaid. That represented 5 months, and we've used up 1 month at the end of June because this time period covers us from starting on June 1. So June has now elapsed. We're at June 30th. And so let's just take this divided by -5 because there's 5 months. And we'll just say June advertising expense. Prepaid, and up here we could say prepaid advertising expense, 5 months, June to August. June, July, August, September, October. June to October, sorry. I thought I was saying that wrong. So that's not 5 months, October. Okay, and then ending prepaid advertising expense at 6/30. So we should end up with $4,800. And here what we want to do is we want to reduce our prepaid advertising expense. So I'm just going to link this up here. So prepaid advertising expense goes down by $1,200, just like we showed here. And then we want to record advertising expense. Now, the actual expense is the offset for our prepaid advertising expense asset being used up. And so we can just say record, what do we say, June advertising expense. Okay, good deal. Now let's go to our next problem. And let's see, what do we got here? So that was prepaid advertising. Now we have prepaid insurance. So very similar situation, but in our prepaid advertising insurance, prepaid insurance, it's 3 months at $1,200 total. So that gives us, I'll just put it in here, prepaid insurance expense, 3 months. And again, that was June to August. And so again, it didn't start until June, so we've had just 1 month used up. And it was $400 equals this, whoops, divided by -3. That tells us, it was 3 months. So 1 month's worth is $400. And then I can just link, I'm just going to link that over. And so we recognize 1 month of expense because we actually used up, that month of insurance. Oh, and let me change this to insurance expense. And our prepaid insurance expense asset, which started at $1,200, we're now reducing by $400, and it'll have an ending balance in its ledger of $800 now. And we'll be recording June insurance expense. Okay, fantastic. And let's go to the next one here. That was prepaid insurance. Now we have our notes pay, our note that we have outstanding. And what we want to do here is record some interest expense. And we're going to have an interest payable as an offset to record the other side as we accrue the interest expense. So one moment here, just gotta text back my wife. Okay, so let's go ahead and look at our note payable and all that and do our little calculations and analysis. And yes, we got $50,000 is what we borrowed. So that's our loan principal. And let's see here. Let's say annual interest expense is just taking this times, what was it? 8%. 8%. So $4,000. This one's not quite the same as the rest of just reducing an asset. But here's some other calculations. So our total annual interest expense would be $4,000. And we are recording, we want 1 month's worth, not 1 year's worth. So let's take that 4,000 divided by 12. And then we can basically just say monthly interest expense. I'm just going to link over to my calculation. And we'll say record June interest expense. Okay. And let's see here and just remember, just to think about this, not that the problem asks us this specifically, but if we had taken, if we took out this loan on May 1st instead of May 31st, and we would need to record 2 months of interest expense, then we would take this 333 times 2, basically, right? But since we took it out on May 31st, we're just recording 1 month in this entry. Okay, and finally, our last adjustment here will be for depreciation, and this is related to our purchase of our computer. So we'll say depreciation expense. And we'll say accumulated depreciation, and we want to specify what it ties into. So we'll say computers, because different types of assets will have different. If you have a building, that the accumulated depreciation will reduce the building account. So it's good for when you record accumulated depreciation to identify and have specific accounts that tie back to which type of asset we're talking about. So just good practice there. Okay, so for this one, let's take a look here. We said, okay, it's got a 3-year life, and it's got a salvage value of $300. And so we bought this on June 1st. So we just need to record 1 month's worth of depreciation expense. So here, I'll do the calculation off to the side for us. So the computer was $3,900. Computer historical cost. The salvage value is $300. So if we take the historical cost minus the salvage value, we get that. We'll just call that the subtotal. And then we want to divide by use. So the useful life in months here because we want to record 1 month's worth, not 1 year's basically. And so it tells us a 3-year life of years. So if we want to do that in, if we want to say that same thing in months, we take 3 times 12. It's 36. So 36 months. And then to get our monthly depreciation, then we just take this subtotal divided by the useful life in months, and we get, I guess, $100 exactly, I think. Yep. $100 of depreciation expense per month. And then we can just link to there. Hope that already worked. And record June depreciation expense. Okay, perfect. So I hope that was helpful. Some of these calculations I think might be nice to see too. And then you hopefully kind of take away from this the idea of, initial transactions being recorded, and then separately the adjusting entries we need to make later, and how those two things kind of differ. When you're purchasing supplies, for example, you get an invoice in the mail to do the original, just normal, accounting for that purchase. And then later you actually have to do some like thinking work. Maybe you have to do an inventory, count. You got to do some other things that's not just receive a bill or send an invoice out to be paid. Unearned revenue, for example, we initially collect a deposit from the customer, and that's the initial transaction. But then later we have to like look and think or do some analysis to say, oh, how much of that original, deposit has actually been earned at this point now, so 1/2 essentially, so on and so forth. So not any kind of intense analysis necessarily or rocket science here, but, it takes some practice to get familiar with what exactly we'll be trying to accomplish. So hopefully that was helpful, and stay tuned. Watch the next video for problem 3.2. All right. Thanks, everyone.